Welcome back to another explainer. Look, today we're unpacking something that, well, people usually think is just a huge compliance headache, but honestly, it's a strategic masterclass in global financial credibility. We're talking about IFRS 1, first-time adoption of international financial reporting standards. If your company is gearing up for the global stage, this is literally your ultimate blueprint. Okay, let's dive into this.
Here's our game plan for today. We'll start with the IFRS starting point, then move into the 4 core transition principles. After that, we'll hit the exemptions and exceptions. And finally, we'll wrap up with disclosures and essential reconciliations.
All right, Section 1, the IFRS starting point, setting the foundation.
I want you to think about moving into a new house. You don't just, back up a moving truck, dump all your old stuff randomly into the living room and call it a day, right? No, you organize. You toss out the junk you don't need anymore. You figure out what goes where so the new place actually works. Well, the exact same logic applies here. When a company moves from its local accounting standards to IFRS, you can't just randomly start using IFRS today and completely forget the past. You need a structured, highly transparent process so that global investors can actually compare your historical trends.
So, that brings us to a really massive question. When you make this big move, what exactly qualifies as your first IFRS financial statements?
Basically, they're the first annual financial statements where an entity makes an explicit and unreserved statement of compliance. And I really want to emphasize those words, explicit and unreserved. This isn't some quiet, under-the-radar shift. This is a bold, unconditional declaration right there in the notes of your financials stating that you are now globally compliant. No caveats, no, hey, we're just going to try this out for a year. It is absolute.
Now listen to me carefully here because this is crucial. What is the date of transition? It sounds super obvious, right? But it is easily the most misunderstood concept in the entire standard.
The date of transition is actually not the day you decide to adopt IFRS. Nope. It's the beginning of the earliest period for which an entity presents full comparative information under IFRS. Let that sink in for a second. It's entirely about your comparative period.
Let's lock this in with a quick example. Imagine ABC Limited wants to issue its first IFRS financial statements for the year ending December 31st, 2025. Well, you have to show comparative figures for the previous year, 2024, right? So, to report in 2025, your starting line, your actual date of transition is January 1, 2024. You literally have to go back in time to the very first day of that comparative period.
And this brilliantly illustrates why we need the opening IFRS statement of financial position, prepared precisely on that date of transition, so January 1, 2024 in our example. This balance sheet is where your IFRS journey officially begins. Now, it doesn't even need to be published separately, but you absolutely must prepare it because it provides the opening balances for your entire comparative period.
Moving right along to Section 2, the 4 core transition principles. Time for the heavy lifting.
So we have to apply IFRS retrospectively, basically acting as if we'd been using it all along. To do this, you follow 4 rapid-fire steps. Step 1. Recognize the items that IFRS actually demands, like bringing in deferred tax assets that your old local rules just ignored. Step 2. De-recognize prohibited items. So if you previously capitalized research costs, IFRS says strip them out. They need to be expensed immediately. Step 3. Reclassify items. For instance, you got to split compound financial instruments, like convertible bonds, into their liability and equity components. And Step 4. Measure under IFRS. If you used to discount deferred taxes, well, stop immediately. IFRS explicitly forbids it.
Now, what's really interesting about this is what happens when you make an adjustment. Say you just had to de-recognize $100,000 of prohibited research costs. Where does that go? It completely bypasses the profit and loss statement. It goes directly to your equity, specifically hitting retained earnings. Why? Because, well, these aren't current year performance metrics. They're corrections relating to past periods. You just debit retained earnings and credit the asset. Super clean and highly transparent.
All right, on to Section 3, exemptions and exceptions, the cheat codes and the hard rules.
Going back decades to restate every single historical transaction is, quite frankly, practically impossible. And the International Accounting Standards Board actually knows this. So they try to balance strict reliability with saving you a ton of time and money. On one side, we have optional exemptions. These are reliefs you can choose to apply to save yourself immense headaches. On the other side, we have mandatory exceptions. These are absolute, ironclad rules where you are strictly prohibited from applying IFRS retrospectively. Let's look a little closer at both.
These optional exemptions are absolute cheat codes for sure.
Imagine trying to recalculate the historical cost of a 50-year-old factory building under IFRS. Absolute nightmare. Instead, you can just get the building appraised at fair value on your transition date and use that as your deemed cost going forward. Or what about past business combinations? You don't have to go back and restate old goodwill and mergers. You can even reset complex foreign exchange cumulative translation differences right back to zero. It's a massive relief that actually makes this whole transition feasible.
But then we have the mandatory exceptions. And let me be incredibly clear here. You are strictly forbidden from using hindsight. You absolutely cannot use post-event understanding to go back and manipulate past classifications. This is especially true for financial instruments and estimates. Basically, the past is the past. So, the crucial point is how this plays out in practice. Say under your previous GAAP, you estimated a $200,000 provision for a legal claim based on what your lawyers told you back then. Now, at your transition date, you know the actual settlement was $250,000. Can you use hindsight to change your opening IFRS balance to match that $250,000? No way. Absolutely not. Your estimate stays exactly as it was, $200,000, unless there was actual objective evidence of a genuine error back then. Estimates remain estimates, period.
Which brings us to Section 4, Disclosures and Essential Reconciliations. The grand reveal.
Okay, so you've done the heavy lifting, you've applied the exemptions, now it's time to show off your newly organized, highly transparent new house to global investors. I need you to memorize this fundamental rule. There are absolutely no exemptions from disclosure requirements under IFRS 1. The standard might give you a few breaks on measuring your assets, but it demands absolute, uncompromising transparency in how you communicate those changes to the market.
To achieve that level of transparency, investors need to see exactly how the transition impacted you. So you have to provide essential reconciliations. You must reconcile your equity from your previous GAAP to IFRS at the transition date and then do it again at the end of the comparative period. Plus, you need to reconcile your total comprehensive income. Users absolutely need to know if your numbers changed because your actual business performance changed or simply because your accounting rules changed.
And because of this retrospective shift, we have what we call the Rule of Three. When you present your first IFRS financial statements, you don't just show 2 balance sheets, you show 3. You have the opening statement of transition, the comparative year-end, and the current year-end. This trio guarantees that stakeholders aren't left scratching their heads, confused by shifting policies. But listen, IFRS adoption isn't just some abstract exercise for the folks in the accounting department. The broader business impacts are absolutely immense. Think about it. You might need entirely new IT software just to track new lease liabilities. Your debt-to-equity ratios will probably change, meaning you might have to renegotiate loan covenants with your bank before they call in your debt. If your reported profits drop under IFRS, you have to redesign employee bonus schemes to avoid a total riot. And if your earnings per share changes, you better be out there communicating clearly with investors to prevent a panic sell-off. Which leaves us with this final, really important thought. When you approach IFRS 1, are you just begrudgingly changing the numbers on a spreadsheet? Or are you executing a strategic master plan for global financial credibility, lowering your cost of capital and attracting worldwide investors? Honestly, it's a superpower if you use it correctly. So get out there, plan thoroughly, and execute smoothly. Thanks so much for joining me on this explainer, and I'll catch you on the next one.